Greetings from our team at Robare and Jones Wealth Management, and Happy New Year to everyone. We hope this note finds you well. Before we begin, we want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So again, we want to wish everyone a very happy new year. We look forward to seeing many of you at our upcoming quarterly investment forum on Wednesday, January 21st at Perry's. We're expecting over 100 in attendance. We look forward to seeing many of you there. We also want to celebrate a milestone with the team member Ann Fasoni, who is celebrating 20 years of amazing service to our team and our clients this year. So congratulations, Ann. So since we're in January, we're going to do a little bit of looking back, but mostly looking forward into 2026 and the things that we're following. 2025 was a wild year, and we're going to kind of talk about a few of the major events. Started with, if you remember, late January, DeepSeek, which is a Chinese AI company that affected markets dramatically. In fact, the one-day price move on NVIDIA late January was down 17%. Then in April, we had tariff news, and the markets responded by being down 19% from the high point to the low point in early April. Then by June, we were bombing Iran. The tax bill passed in July. And then toward the end of the year, we had the largest shutdown in US history of the government from October 1 to 11/12. And yet, what's interesting as we close 2025 is the markets closed at or near all-time highs, which just punctuate the fact that knowing what we don't know, that we never know as we look at all of those events that were challenging for 2025, we never know what the market's already priced in, and we never know what other factors the markets are responding to. So as we turn the page into the new year, now what in terms of the things that we're following? Well, as we've kind of framed some tailwinds and headwinds, so tailwinds are the things that could go right, continued AI spend, easing of financial conditions, fiscal stimulus and tax cuts, consumers, especially at the high income levels, the demand remains strong and lower energy prices. So those are some things that are supportive of continued stock market appreciation for 2026. The things that are challenging is the jobs market that is slowing, inflation that remains above target, although down from prior highs, trade policy and geopolitical uncertainty. Valuations are high. There's really nothing that's inexpensive now in the markets, and debt remains an ongoing issue, both deficits and cumulative debt. So some recent data, inflation came in most recently 2.7 year over year, which again is the kind of stubbornly above the Fed's target, but also well below historic highs. The most recent jobs report was lower than expected for December, 50,000 jobs added. Unemployment rate dipped a little bit to 4.4%. And as the Fed is monitoring both of those and has both full employment and price stability as part of their dual mandate, we look at kind of where the rate cycle has been. We've looked at this before, massive rate increasing in 2023 and 2022 and 2023. Then we started cutting rates in 2024. That continued in 2025 with 75 basis points of cumulative cuts. The Fed did indicate that about a week from now, that the Feds will pause at their meeting in January. But keep in mind, the current rate is 3.5 to 3.75 in terms of the target. The terminal rate, we're not going to go to zero on the terminal rate. The terminal rate, we're probably 50 to 75 basis points away from. So we do expect more rate cuts in 2026, but likely not as much or as quick as we saw in 2025. So the economy finished the year strong. The initial read on Q3 was 4.3%. We get a next release on that same time frame in late January. So as it relates to what analysts are predicting for 2026, price target kind of an average price target in the S&P 500 is 7,500. That's about 7% higher than we are today at just under 7,000. We continue to have a market that's top heavy. Within market cap, the top 10 companies, the S&P 500 being about 40% of the index. One thing to kind of think about that in context is that the earnings, while they're not as high as 40%, they are basically tracking. And so what you want to see here is not a huge spread between price or market cap and earnings. So again, earnings look in large measure to be supporting the market cap weighting. And another way to think about that is kind of the dot-com bubble that burst compared to kind of the AI technologies of today. So when the dot-com bubble burst, you had earnings growth of 80%, but stock returns that were almost a 6x greater than that. Today, you have earnings growth at about 73 and stock returns at 94, going back to Q3 of 2021. So what this is telling us is that the stock returns are more matching where earnings growth is, as opposed to this at about a 6x period of time. So there are some comparisons to the 2000s, but again, in terms of price appreciation compared to earnings growth, it's not nearly as outsized in the environment that we're in today. However, we do have a very top-heavy market with the top 10 companies in the S&P 500 are now a full $19 trillion worth of value, compared to only 40 years ago, that was 251 billion. And that kind of top of the S&P 500 at top 10 means that this group is worth more than the combined GDPs of all of these countries listed. So again, hard to believe that that's the case. Not only is the top 10 40% of the S&P, but it's more than the GDP of all of these combined countries. So where are we in the current bull market cycle that started in October of 2022 has now gone up a cumulative 93%, and for a period of time of just over 3 years. If we compare that to an average bull market at 192%, and on average about 5.5 years. So analysts are predicting the 10-year ends the year about where it started, which is about a little bit over where we are today. But the range of fixed income outlooks go from 3.5 to 445. And again, we sit at about 415 today. So there's not big expectations of rate changes, even though the Fed's going to continue to cut. 3.5 to 445 is a pretty tight window of what analysts are expecting for the 10-year, the remainder in the year. One interesting phenomenon is that cash on the sideline sits at about 8 trillion, just under it. And if you look at other periods of time where money market values have peaked, and you look at stocks, money market, and U.S. bonds over these periods of time, you'll see that money market assets being at a peak is supportive broadly of equities going forward. So we have elections coming up later this year. Just to give you some odds where things sit today based on Polymarket, is that the Republicans only have a 27% chance to hold the House in the midterms, and a much greater chance to hold the Senate. So what odds look like today is a split Congress between the Democrats likely controlling the House and the Republicans likely controlling the Senate as we sit here today. And as we look at where we are in presidential cycle, we're in year 2, which is a midterm year. The average return is lower than the other years, and the volatility picks up. So this year, going back to 1950, tends to be a lower return and a more volatile year. Sentiment was revised down recently. So in terms of where the mood of the consumer is, it's pretty negative overall, something to keep an eye on. And kind of zooming out as we look at 100 years in the market, this kind of just frames the amount of time that the markets are up versus down. and how much they're up in the positive versus negative years. So going back again 100 years, 73% of the time markets are up, 27% of the time markets are down, and when they're up 2 to 1. In terms of volume, 21% the average up year, negative 13 the average down year. We will be rebalancing in the coming weeks and sending trade notes out in advance to let you know kind of what parts of the market we're favoring given all of the information that we've shared. So with that in mind, we'll close. Again, we want to wish each of you a very happy new year. We look forward to seeing many of you at our forum on the 21st at Perry's. If we can help you out with anything, please let us know. We're here to serve you. Again, thank you for the trust and confidence that you place in us. We hope to see you all again very soon, hopefully at Perry's next week. Until we see you again, be well and take care.